The Reserve Bank of Australia has slapped down the pessimists who are concerned that its supersized rate increases will crush the housing market and economy. Well, let's dive in and have a look and really see what's going on. Starting off from the top, as we can see, the Reserve Bank of Australia is slapping down the property doomsday sayers. And in her first speech, Deputy Governor Michele Bullock delivered a crucial RBA analysis and argued that household balance sheets can handle a potential rate increase to the official cash rate being at 3% by mid-May. Now, for those that are aware, the cash rate at the moment is at 1.35. There's talks of a potential increase in rates of 0.5% for next month and another one of 0.5% in September. That would bring the official cash rate up to 2.35%, and then for the potential another 0.7% increases come next year. Now, it also goes on to say that households have large prepayments on their mortgage, they have cash buffers and solid equity in their homes, and have borrowed under stricter lending policies in recent years. And that's what Ms. Bullock has been saying here. I guess in terms of the Cynics, they're saying that the RBA needs to justify why households can afford significantly higher than anticipated rates after being misled. So they misled a lot of borrowers last year, saying that the cash rate wasn't going to change until 2024. Nonetheless, Bullock delivered an extra nugget and foreshadowed that the current 1.35% cash rate must go up a fair bit higher to reach neutral, which is estimated around that sort of 2.5% is what Philip Lowe has mentioned there. All this, in a way, they're trying to grapple with inflation. They're trying to calm the market down. I guess it's a little bit like Goldilocks. They need to get it just right. Now, Mr. Philip Lowe also goes on to say that a neutral rate is probably that 2.5% mark, like we talked about earlier, and hinted that the bank might need to go above this and impose stricter policies to, I guess, combat what they're trying to get there. He also said that the level in which we need to get to a neutral is potentially only going to be known in retrospect. So when they're looking back in the history books of that, it's interesting to see that Ms. Bullock also goes on to say that we're well placed for these rate rises. And even the banks are starting to believe that by the early next year, the cash rate's going to be about that 3%. ANZ came out recently with that. CommBank also saying they see back-to-back further 0.5% rate rises coming in August and September. And we actually are seeing that a lot of homeowners are still fixed. And when those fixed rates come out, they're going to have a bit of a jump. So there's going to be a 40% increase on the fixed rates that are ending and expiring over the next 18 months, which is a bit of an increase for those that have mortgages that are currently on fixed. A lot of them got to fix in around that 2% or 1.99% mark. Now, I guess one thing you can do is if your fixed rate is coming up, a lot of banks actually revert you to a higher variable rate. So when your fixed rate ends, so let's say you're paying $580,000, you're paying 2% at the moment, living the dream, you're sort of paying $2,144. A lot of banks will automatically revert that fixed rate to a variable rate when it ends, and it jumps to a higher variable rate than they actually offer a lot of their customers. So what you'll find is you might actually see that your variable rate jumps up to 4.5%. That sees your repayment skyrocket to $2,939. But the good news is there's other banks out there. If you review your mortgage, so get in touch with us. We can have a look at it, and you can actually get those repayments down, because there's a number of banks doing that 3.14% rate at the moment, where you're looking at $2,489 per month, pretty much for the same thing. So get in touch with us. We can definitely look at that. But continuing on with what they were talking about here, Ms. Bullock's speech was pretty much talking about the fact that she rejected the pessimistic assessments of the RBA watchers, who say that the bank risks the policies that they're being too aggressive and that they're going to smash the housing market. I mean, the Commonwealth Bank is sort of saying that they are concerned with these sharp rate rises. It might accelerate the falls in the housing market, reduce wealth, and dent an already low consumer confidence, and cut spend and noticeably slow down the economy. This is amid forecasts that house prices may fall a further 15%. Now, the Reserve Bank had some interesting figures on negative equity here. Bullock goes on to say that about 10% of, if there is a 10% cut in house prices, so if house prices fall another 10%, it'll only put 0.4% of home borrowers in negative equity. And if they fall by 20%, it puts 2.4% of borrowers in a negative equity, which is below the levels they saw in 2018. Now, I do have a graph I want to go through in a minute, which shows the house prices growth in comparison to the United States in the past. But I just want to cover some of these points before we do. Now, Bullock also presents that the Reserve Bank is confident. They believe that credit to income ratios in Australia around 150% is historically high in gross terms, but over the looks, there's about $260 billion in extra pandemic savings in deposits and mortgage offset accounts, which I guess previously weren't there. Over half of variable borrowers have more than 2 years advanced mortgage prepayments, and household credit to income in terms of net real terms is similar to what 2007 levels were. Moreover, the large amounts of household debt held is with higher income earners, including investors who tend to have bigger liquidity budgets. So what they're sort of saying is three quarters of the debt outstanding is with households with the top 40% of income distribution, whilst the bottom 20% only account for 5%. It also goes on to talk about what we just went through earlier with the variable rate borrowers making larger than necessary repayments and are well positioned for mortgage rate rises, is what Bullock says. And the Reserve Bank is going to remain watchful, but not overly concerned. Well, let's have a look here at some details as we talked about. We know one of the key drivers that the Reserve Bank will keep an eager eye out on is unemployment, still at historically low levels. The other thing they're going to look at and keep a keen eye on is property values and how that comes to par. As we can see here, if we're looking at Sydney over the last 10 years or so, we can see the values of property prices increasing, and it's not uncommon for property to go through a cycle. So we see a boom, then a recovery, a bottoming out, and then it coming through. And we can see that with most markets, Melbourne being the same, and so on and so forth. Northern Darwin probably having the worst track record of them all. Perth starting to get back to their historic levels of 2014, but had a very sort of lull period of time for a long period there. Adelaide having some sharp growth there, consistent growth. Canberra as well. Hobart having some pretty spectacular growth, as we can see here. And then the average weighting over the 8 capital cities there. Brisbane was somewhere in here as well, if I can find it. Let me just see if I can find it. Where are we? There's Brisbane here. So we can see there that we've got some pretty steady growth. Now, one of the things that Australia has got going forward is its saturation. You know, we've got 8 capital cities where a lot of the property is concentrated in very specific areas, 10, 20 kilometers from the city. That helps with that demand piece and supply as well, because it keeps values moving in a fairly steady direction over time. Yes, we know property does go through cycles. So as we can see, Sydney back in 2019, when COVID first hit, had a fairly large downturn, but then when things started to turn around, rates went down, it had a bit of a peak again. Now, comparing that to the United States isn't as concentrated as we find in Australia, and they're more subject to those boom and bust. And we can see those sharp increases and sharp declines. And we can even see their 2005 levels or 2008-07 before the global financial crisis. It took a very long time for them to get back to where we were. We didn't quite see that with Australia, as we can see here. We don't have data going back that far, but we can get an idea of how different the market is in comparison. Now, it does go on to talk about those that took advantage of those low fixed rates. We talked about it before, around that 2%, are going to find that once their fixed rate ends, there's going to have a sharp increase. With a pool of fixed rates expiring, they're going to find that it'll increase their repayments by about 40%. Now, there's a huge amount of fixed rates expiring at the end of 2023, and the medium increase that most borrowers are going to expect is about $650 a month on their mortgage repayments. I guess to finalize the details with Philip Lowe, he's a glass half full type of guy. So he talks about it's a narrow path that they need to meet, competing with priorities to reduce inflation and keep unemployment low around that 4%. So that gives us a little bit of food for thought as to what the Reserve Bank's thinking, what some of their data and modeling is coming out, that they're seeing households in a position to weather these rate hikes. And they're also saying that interest rates need to get up to be at that normalized level, whereby the interest cost isn't negative relative to inflation. Now, here at Hunter Galloway, guys, we're mortgage brokers. We're based in Brisbane, but we deal with people Australia-wide. So if you're in Perth, Melbourne, Adelaide, Sydney, Hobart, we can help. Hit us up at huntergalloway.com.au or call us on 1300 08 065. And we'd love to have a chat with you. Josh, Jaden, and I are all brothers here. We'll field your questions, answer them, and assist you in understanding what you can do. Thanks again, guys, and we'll see you next time.